Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and success strategies. Hello, I'm Michael Bull, and I appreciate you being with us. This segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Today we're talking about commercial real estate financing. We're calling the show just that, commercial real estate financing today. And it's interesting when you look at financing, sometimes the way financing goes, real estate goes, and it's certainly a barometer of what's going on in the commercial real estate world as the lenders and everyone involved in that market is really closely looking at the economy and the market. Now, we've recently had some rates lowered by the Fed, right? And we're close to the end of the cycle. So I think there's a lot of interest in the debt market and what's happening. That's what we're going to cover today. Please welcome my first guest. It's Joe McBride, and he's Director of Research and Applied Data with Trepp, and he's joining us on the phone. Joe, thanks for being with us, sir.
Thank you, Michael. Thanks for having me.
Well, as you analyze and look at this market all the time from your desk, what are you seeing for transaction volume and availability of debt right now?
Sure. Well, from where I sit, the availability of debt couldn't really be any better right now. Trepp is really focused on the commercial mortgage-backed securities market and the structured products world, which covers just about a quarter of the total commercial real estate finance lending environment. CMBS issuance right now is on pace to just about hit the same mark as it did in 2018, which was around just over $80 billion in new issuance. Underwriting trends, loan to values, debt service coverage ratios, loan rates, those are all kind of, at least from our point of view, still in pretty safe territory. And given the, Powell coming out not too long ago and lowering rates, I wouldn't be surprised if we saw a little, couple of month increase in refis that might not otherwise have happened.
Yeah. And of course, we're not in a market with a lot of defaults, but there's always some amount of defaults all the time, right, Joe? What are you seeing for trends there?
Sure. So our overall, Trepp CMBS delinquency rate is at an all-time low right now, which is great. It's also a little bit scary because anytime you see anything that's good at an all-time low, you're expecting a little bit of an increase. But then again, I can remember being at my desk in 5 years ago saying, are we at the top? Are we at the top? So sure, we are starting to see some, delinquency, some watch listed loans, some specially serviced loans from post-crisis deals. I think a lot of those are happening just as a natural kind of state of how any pool of commercial real estate loans after 2 or 3 or 4 years, a couple of them are going to run into some sort of issues. I don't see any outsized increase happening in any new issue areas. I think, you have your normal story of retail and what's going on there, but I think a lot of that has been baked in to the underwriting of new deals and also to the kind of loss expectations or the dispositions that have already happened on old deals. So we have nowhere to go but up in terms of delinquency, but I wouldn't be surprised if we bump along at a very, very low rate for the near future.
Yeah, and like I mentioned in the opening, the availability of financing can really impact values of commercial real estate. And there's some new accounting standards, right, coming out that could potentially impact availability of debt. Tell us about that, Joe.
Sure. So, there's a new standard starting in the beginning of 2020 called CECL. It stands for Current Expected Credit Loss. Now, don't fall asleep on me. I know it's an accounting standard, but it is pretty interesting because it takes an old standard, which meant if you had a book of loans, or you're a bank and you have loans on your balance sheet, if you had one or two that you expected to take some loss that maybe were in foreclosure or REO, you would then have to create a reserve based on how much loss you expected for those particular loans. Now that is going away, and what's replacing it is CECL, which means that banks and other lending institutions that hold loans on their balance sheet, they will have to reserve for the total life of loan expected credit loss on all of the loans on their balance sheet. So you can think, for somebody who has 50 or 60 loans, that's not a big deal. But for a bank, a mid-sized bank that has 5,000 or 7,000 commercial real estate loans, this can be a really big impact on their earnings because it's something that goes directly to the income statement, and also just on, how much they have to spend logistically on data and modeling capabilities and quantitative capabilities that maybe they didn't have in-house already. And just to end that point, when you book a new loan, now you're going to have to reserve some credit loss against it. And, we're kind of waiting to see how that affects the availability of commercial real estate finance from these typical players, as well as if it has any effect on pricing. So I think those two questions remain outstanding. It's definitely a big topic in the market, in the CRE finance market. And I guess, we're going to see in a couple of months starting in 2020.
What would be an example of reserves that would be required for a loan that's in good standing and has just been created?
Sure. So if you ask the originator, he'd say 0%, right?
Yeah.
Because nobody expects to take a loss on a loan when they write it. And that makes sense. But I think historically, if you just look at banks who lend on commercial real estate, they have current reserves in place of anywhere from 30 basis points to 130 basis points. And if you really dive down into that, a lot of that reserve is actually due to, regulators pushing for banks to have higher loss cushions just in case losses occur. So I would say you're kind of in that, that same range now. But you could end up seeing it be a little bit higher because of the expectation that now that we're reserving on the whole book and we're reserving for a whole life of loan instead of just for 1 year, it should technically be higher. So whether that actually does affect how, an originator is allowed to price a loan or the type of terms that an originator or an underwriter is allowed to give, that's where you could see it really affect the front of office operations.
I see. So CECL reserves might adjust for each loan differently. There's not just a stated basis points that is required for the loan amount overall. Just it could adjust.
That's right. It's supposed to be based on, the underlying loan and property information, as well as the bank's or the lender's expectations of the future macroeconomic world. And that's where, because there's no set rule, it makes it hard to implement, because it's an estimate as opposed to a prescriptive rule.
Yeah. So everything is supposed to get easier and safer, becomes more difficult to figure out. Well, Joe.
Oftentimes with policy decisions, that's what happens. Yeah.
That's right. Well, Joe, what do you see for rates? As we mentioned, the Fed just lowered their rate. And what do you expect moving forward, and what trends are you seeing right now?
Sure. On the rate side, it's interesting. We've been talking about this yield curve inversion for many months now, and how that's oftentimes an arbiter of recession. Now, on the other side of the coin, you have the argument that the long end of the curve is really being deflated by how much capital is flowing into the U.S. from negative interest rate environments in Europe, right? So whether the inverted yield curve now is really an indicator of recession or not, I can't say. I wish I could. But in terms of commercial real estate on the ground, I think I was in a meeting 2 weeks ago when the Fed made the announcement about interest rates going down, and we were meeting with a player in the commercial real estate finance market, and they said, we have to go. Our phones are ringing off the hook on refinances. Mm-hmm. So I wouldn't be surprised if you saw a nice blip, an increase over the next 2 or 3 months, or just to finish out the year, where we may have expected to be in the 80 billion issuance area for 2019, and maybe we end up a little bit higher than that, and be pleasantly surprised because you start to see a few more refinancings than we originally expected.
And Joe, what do lenders overall think about asset values right now?
Yeah, I think it's generally known that we are at a peak, right? Or at least we are at a high. If you look back in CRE price indexes and look back at 2007, we are now decently above that peak. At the same time, though, back in 2007, lenders were lending to higher leverage levels. So, where in 2006 and 2007, the average loan to value on a new commercial real estate loan in CMBS was around 70, we're more in the 58 to 60 range now. So even if you say, yeah, valuations are very high, we still have a lot of cushion built into these loans that, if things were to go down by 10 or 20%, the loans technically would still be safe. Now, primary gateway markets where the big institutional players play, we're starting to see some softness in terms of, condo sales and rent on the multifamily side and occupancies, things like that. But I think cash is always going to flow to those markets, both from the U.S. and from outside the U.S. And I wouldn't be surprised if there was a little bit more room to run in kind of those secondary and tertiary markets.
Yeah, and those lower loan to value ratios, obviously it always makes it a lot safer for the lenders and those that invest in them. Well, but there's also now a lot more bridge lenders, right, that help you get a little more LTV. What do you see there?
Sure. So that's a good point. Right now, we have seen a very significant increase in the issuance of commercial real estate CLOs. Those are collateralized loan obligations. They're essentially pools of 2 to 5 year floating rate commercial real estate loans on what we would call transitional or semi-transitional properties. So an office building that is 50% occupied, needs to be renovated. There's a business plan put in place, and a lender that lends, like I said, for that 2 to 5 year period with the expectation that at the end of this, the property is going to be repositioned and it's going to be 100% occupied and the value is going to be increased significantly and they'll be able to get taken out by longer term fixed rate financing. The issuance of those securities doubled last year in 2018, and we wouldn't be surprised to see them double again in 2019. There's a kind of a big, large demand out there for these types of bonds that are backed by these loans. First of all, because they're floating rate, and in a volatile interest rate environment, fixed income investors like floating rate bonds. And they're also shorter term, right? So shorter duration means less exposure to increasing interest rates. And that's where we've seen a lot of demand push towards those types of loans and bonds.
Interesting. Well, increased returns usually means an increased volatility, right, or risk. So what do these creators of these CLOs say about the risk involved?
Sure. So on the lender side, like same tongue-in-cheek comments about CECL is, a lender never expects to take any loss. There is something to be said for the structure of these types of loans, the underwriting that's done, the due diligence that's done. A lot of these types of lenders are on the smaller side, as opposed to the big JP Morgans of the world. These are more like mortgage REITs and private equity funds and things like that, where they have relationships with the sponsors. They understand the business plan thoroughly. They understand the markets and the neighborhoods and the property types that they're working with. And they build a lot of safety into the loan structure, right? They'll have interest reserves. They'll have recourse to a wealthy sponsor who's sponsoring the project. And they'll have a lot of, let's call them covenants, right? So the sponsor has to meet certain goalposts throughout the project life in order to get, future funding and to get the loan funded to its full commitment. So while they are technically riskier because it's not a 100% occupied, stable, fixed rate financing. There is a lot of structure and a lot of underwriting and due diligence that goes into it, which does give both the lenders and the investors on the bond side, a decent feeling of safety.
Yeah, and definitely a place for those type of loans at all times, but especially today. Well, Joe, before we let you go, what could be a quick tip you'd leave for our listeners? Maybe if they're a borrower or a lender, or one of the two, what tip would you leave them with?